Hello, hello, hello. Hope you're doing well. So it's a beautiful day. So we should be beginning in the next few minutes. I'm waiting for the rest to join so that at least we get started. So
will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet that gets deployed.
This is more complex than people think. Steering wheels on the wrong side of the truck. That's the first thing.
Oh my God.
okay, let's begin.
Man on Twitter that captured this moment.
Wait, question. Who of you has a driver's license?
You don't make sense.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first.
So I'm still waiting for the rest, but as we do, let's have a look at what has been happening to the markets. So technically, gold went up. Let me put my Bloomberg off here. Okay, that's okay now. So Philip, okay. You're welcome. You're welcome. View. So let's begin today's class. So today I was talking about candlesticks. So there's a book I've already sent. And I hope I'm audible enough. If I'm not, you can always raise your hand and tell me, hey sir, pause, then we have a look. So today I'm going to have a very interesting class on candlesticks and the psychology of markets. So psychology basically is why are we here? What do we do every day? So once you understand how the market operates and what we do every day, then you'll be at a very, very winning point. So one of the most important things to understand, apart from understanding price action, like for example, this is USD chef. So I had told guys we were short it. I had also told guys we were going to buy gold. And you can see that's exactly what happened, especially yesterday. We are at 1795. And you can see the bulls are almost up by 98% using my trading volume here. So that is to mean this momentum is still really, really much going up. You can see it shot down, then it. So all this or whatever I'm talking to you about is usually, so give me a minute. I think I have more people coming on board. Okay, thank you. So let's begin. At least with 6-7 people, I'm usually okay to get started. So also mute. We agreed if you have any questions, always type. So the chat is here in case you got any queries, any questions, you can always kindly type.
Mnasema aje unaniangalia hapo?
So let's get started. So basically, in case you got any questions, kindly type here. So today I have more time with you. So that's why we began the classes a bit early, so that at least I'm able to have enough time with you. So let's get started to the point. So today I've sent a book. I believe you have the WhatsApp group and you're all in. So page 147, I've already texted you. We are supposed to do a quiz. It looks like this. Let me show you the quiz. The quiz looks like this. Answer 25 questions as accurately as possible to find out what kind of a trader you are. So the reason to do this quiz is for me to be able to understand what kind of a trader you are, because we do have different kind of traders. Let me just show you from above here. So this one is not complete, but the book we just sent is complete with also some very good strategies. So before I go to the candlesticks, let's just understand the markets and who you are. So let's see the different types of traders we have. So just a minute. So, and so that you are able to understand why we do what we do every day. So I'm just going to go through it maybe within like few minutes so that you are able to see why some are very successful and of course some are not. So there's an experiment here you're going to do. So this book is really nice. I really like it. So play it your way, chapter 5. So this one is on page 14, but this one is not complete. But the one I've sent you, page 147, you're going to see everything there. So this chapter provides insight into 5 different categories of Forex traders. We have scalpers, we have day traders, swing traders, position traders, and mechanical traders. So after reading, you will understand the difference among the 5 and the 3 advantages of each category. This chapter also includes a test to help you determine which category you belong. So I won't read all that because these are just the normal markets we have. So the experiment mostly is understanding. Now, when we go to, let's go down, Sports Illustrated. So you read all these because I don't have the time. I just want you to know. So recently, Global TV Giant Entertainment and Sports Programming Network, ESPN, came up with a list of 10 skills if that determined make up a successful sports person. So I'm really so much into sports because I'm able to analyze the markets just the way you can look at sports with your favorite team or jersey and be able to win. So for example, in the Olympics, I think we had Tokyo Olympics, we bagged like 4 or 5 gold, which was okay as a country. But the idea for a sports person to really win, they have to have a really strong mental strength, not just mental strength, even physically, emotionally, everything. All their wits should be really at 100%. They need endurance. They need a lot of strength, power, speed, agility, flexibility, hand-to-eye coordination, nerve. What's the nerve? This is defined as the ability to maintain composure in a fearful environment. Probably this person is meeting someone, a stronger opponent, or probably they are losing in a game. What keeps them going? Durability is defined as the ability to withstand constant physical punishment, and analytic aptitude, defined as the ability to evaluate and react to strategic situations. These are the same things we will be facing when we are trading the markets, because there are sometimes you're making a lot of money, of course, sometimes you're not. How do you handle yourself? So it analyzed 60 sports and asked a group of experts made up of sports scientists, academics, and sports journalists to assign number 1 to 10. So among the 60s, baseball came out tops. The hand-to-eye coordination rating, 9.25. Soccer led the pack. So, soccer is big, football everywhere, Europe, Africa, soccer is everywhere. And the agility category with a rating of 8.25. Motor racing was number 1 in the nerve category with a rating of 9.88. These are the Ferraris and sports car racing. Track and field printing was placed first in the speed category with a rating of 9.88. And finally, boxing emerged victorious in the durability category with a rating of 8.5. Hence, to ensure the highest chance of success in any given sport, a sports coach would put an athlete through a series of tests to determine his or her strengths and weaknesses. So this is what I'll be doing, especially with you, because I just need to understand what's your greatest strength. Are you good at scalping? Or what's your greatest weakness? So if the athlete scored the highest in the hand-to-eye coordination, baseball route would be apt. The athlete came tops of the agility category, soccer would be top. So these are the 5 categories of the Forex traders we have. So I don't need to go through all that. It was just an experiment because the idea is I can't really know you. To be honest, it takes time. Even yourself, if I ask yourself, who are you? When I remove your education and probably close your wearing, okay, not that. I'm saying like if I was to remove your titles, that's the word, the titles from the cars you drive or the money you have or your education, who are you? Who can you describe you are? So this is a constant, improvement. It's a constant thing. You get to know yourself every day. You keep discovering yourself on a daily basis. Style is important. For example, we hear about a style on a daily basis from the mass media. Not a day goes without the newspapers, magazines, radio, or TV promoting probably a perfume, apparel, a luxury car, a watch, or a mobile phone. So advertisers know that style is an integral part of a personality. So people have different styles. Me, I like dressing nice. So you can see I dressed nice today. So this is what we are talking about. What kind of style do you use while you're trading? This is why products are painstakingly created with different textures, smells, or purposes. And of course, we have different tastes and preferences. Everyone is different, and the best product is the one that best suits your need. So according to trading, the best product, what really is your greatest strength, that's what we are going to be working on. So the products that you buy tell a lot about the kind of style that you like and reveal much about your personality. What you buy, what you wear, the perfume, the cologne you use, it tells much about your personality. They define who you really are. So they really define who you are. It's the same thing with Forex trading. No two traders have exactly the same style. That's why it's important for you to choose a style of trading that resonates with your personality and defines who you are. So Forex traders all over the world fall into 5 categories. Either we have scalpers, day traders, swing traders, position traders, and mechanical traders. And the main difference between the categories of traders is the time frame employed while trading. Essentially, the length of time in which a trading position is held increases from a scalper to a day trader. So when you put up that trade, how far you want it to go. For example, this kind of trade, how far you want it to go depends with yourself. So essentially the length. So the length of how far you hold that trade will increase you either from a scalper to a day trader to a swing trader and probably position trader. So mechanical traders are oblivious of the passing of time. Their trades are based on a fixed routine, regardless of the time frame and regardless of the market activity. So who are scalpers? They are traders who like fast action. They enter and exit the Forex market multiple times a day, taking a few pips each time. Typically, profits can range from a single pip to 10 pips. These trades can last anywhere from several seconds to several minutes. And in terms of time frames, scalpers will prefer looking at 1 minute chart to 5 minute chart. So that's who scalpers are. So welcome, Eric. Okay, we have also Charlie. Charlie, welcome also. Let's continue. So the actions are mostly centered around the overlapping sessions of the major regions, typically during the Asia close or European Open. So European Open, we usually have it around 10, from Monday to Friday, around 10 a.m. in our normal our East African time. Europe close, US Open. I think that's the New York. When the Europe is closing around 4:30, there's an overlap of the New York session. So scalpers trade during these hours mainly because these are the busiest hours of the Forex market on any given day. This business tends to generate more volume. Why are they trading at these hours? These are the times when the market is opening, European Open or the close of European Open, Open of the New York. The markets become very volatile because they're just opening and as also they're overlapping each other, which in turn presents more trading opportunities. As they need to react to market movements quickly, scalping is most suitable for traders who can devote their undivided attention and focus on the charts for a couple of hours at a time. So spread on the currency is a significant factor in the scalper strategy. Scalpers tend to stay away from the currency pairs with large spreads and focus only on major pairs such as Euro USD, GBP USD, and USDN. Also, scalpers, mostly this will be the 3 instruments they'll be trading or the 3 pairs they'll be looking at. Why are we using the dollar? Because the dollar is volatile, very volatile, and they're looking to make few pips movement within very few minutes and they're out. Then scalpers tend to avoid trading during major news. This is because major news can revoke different emotions in the markets and cause wild swings. So this is very unwelcome. So they're looking at when the markets are quite calm, but there's a lot of volatility. So I need you to understand that. They also tend to use high leverage because most of the time they're putting big lot size. Lot 1, 0.1, because they are only getting few pips and getting out. So they'll be looking, of course, at a high leverage, 400, 500 plus, because they are in hand out of the market repeatedly with only a small profit. You see, this person does not have a lot of time in the market. They're very, very, I won't use the word impatient, but they don't have much time to wait for profit. So they have to get in and get out very, very fast. Risk exposure and the rest. So we also have day traders. The traders now, they're looking at 20 to 40 pips, time frame M15 to M30, the 15 and 30-minute chart respectively. So for day traders, they're looking between 20 to 40. And then peace of mind, they want easy analysis. Basically, look at the day. How is it? How is the weather? That's what the day traders are all about. They do something called structured calculations. Then what else will they look at? They will have a trading plan or a trading journal from morning, say by 9 a.m. to around 5 p.m. They need to know, how was my day? Did I end my day in green or red? Was I profitable or not? So day trading is fun. Usually they trade just a few, though mine mostly falls under swing because I have the patience to wait for the markets to basically play out. Swing traders normally hold trades beyond a day but never beyond a week. So swing, we are talking of maybe 2-3 days. So I'll enter a trade on Tuesday and I'll leave it on Friday. So then you get your, so what time frame are we looking at? 50 pips to 150 pips. In terms of time frames, these are my favorite: 1 hour chart and 4 hour chart. So this is now, you don't have much you're doing in the markets. You're just looking at few 50 to 150 pips. All we are focused in is the price. Is it moving to a direction? So they tend to be a little more conservative than scalpers or day traders. They typically wait for the several confirmation signals before triggering a trade. At the same time, they are not bothered by intraday volatility and price swing. So for swing traders, mostly they are looking for peace of mind. They're also looking for a favorable risk to reward ratio. We are looking 1 is to the ratio of 2 or 1 is to the ratio of 3. That means if I risk 20 pips, I'm looking to get 40 pips. Or if I'm risking 20 pips, I'm looking to get 60 pips, and so forth and so forth. We are looking to save time, hassle-free, and basically don't want to keep checking the market. Probably they are very busy. Most of the swingers, you'll find they have another job or another business or something else they're doing. Then we have position traders. These ones can wait from D1 to weekly to monthly charts. So this is where I mostly fall under, because for me, I'm able to analyze the chart even for the whole year. I'll tell you, this is where the price is going, inflation levels are these, COVID, vaccines, and all that. So position traders have the longest time horizon of the different categories. The total opposite of scalpers, position traders can sit on a trade for several weeks to several months. They have a very strong grasp of market fundamentals. So for position traders, mostly you'll find their institutions. They are trading very, very big money and are able to spot changes that could lead to highly profitable long-term gains. Long-term gains, you're talking of 400 pips, 500 pips, even up to 1,000 pips. So depending on the currency pair, the profit potential per trade for position traders can range from 500 pips to several thousand pips or more. It's usually interesting because I've been doing this at least for the last 7 or so years, and it's been so much profitable. In terms of time frames, position traders will prefer looking at D1, that is the daily time frame, weekly time frame, and even the monthly charts. So we are looking at daily, weekly, and monthly charts. So position traders are usually sophisticated investors with 2 distinct characteristics. The astute reading of the financial market makes them totally unconcerned with the short-term or even the medium-term movements of the currency market. And they own a large trading account. So for you to really position, at least you're talking between $5,000 to $20,000. No, let's say between 5,000, 10,000, and 20,000 USD for you to really be able to do position trading. This size is necessary because capital is needed to withstand large floating losses, big drawdowns and hedging and all that. You need a lot of capital. So position traders offers this top 3 advantage: lower transaction cost. Brokers charge a spread for every position. I believe you know that, executed in the Forex market. Thus, scalpers incur the highest costs by virtue of their trading currency. So every time you enter and leave a trade, there's a cost associated with that. We call it a spread. So position traders are on the opposite end of the pole. Instead of executing many trades, they are looking to execute few trades and prefer to manage those trades effectively. They're also very good in risk management. They do this by tightening their stop loss for open position, which is a technically dynamically shifting it here and there, and swap. So we're also looking to do something called carry trading. So I'll probably talk to you about that later. Carry trading is whereby you earn swap. So in every transaction or in every Forex transaction, the trade will involve borrowing one currency to buy another. So every time you're buying and selling, you're borrowing one to buy, you're borrowing one currency and also you're buying another. Interest or swap is paid on the currency that is borrowed and earned on the last one that is bought. So as an example, if you are buying a currency with a higher interest rate than the one you are borrowing, the net interest rate difference will be positive. and you earn interest for every day that. So I really enjoy swap trading or carry trading. This sometimes is called carry trade. You can see here, position trading, position traders stand to gain a huge amount of swap when they hold trades for an extended period of time. Also character building, emotions sometimes set in when the markets are ahead for a long time. Both greed and fear can take over during the course of the trade. So position traders have to learn to manage greed when a sizable profit builds up. They have to weigh the decision of exiting the trade early to bank the profits against holding the trade longer for even bigger returns. So the opposite is also true. When trades go against position traders, fear is bound to set in. Then they have to weigh the decision of exiting the trade early to realize the loss against holding onto the position in the event the markets reverse. So this is basically psychology of the markets. So what about mechanical traders? They're usually beginners in the Forex market. Their main focus in trading the markets is not time driven, but system driven. So this one mostly they'll have a system, very good indicator or robot or whatever they're using, but they just have a very good system. What are they looking at? After mechanical traders go through a period of backtesting, so they have to backtest their system with historical data, they deem a particular strategy sound. So they have to really test it out. Thereafter, these traders will focus only on the execution of that strategy based on its rules. This method allows them to enter and exit trades without emotions or stress. And due to the robotic application of mechanical trading, it is not uncommon to find mechanical traders coding their own strategies into automated system that can be fired off the queue. So you also find most of them, especially this year, I've seen there are so many of them and they're very, very profitable. The mechanical traders, you will find out, like right now, there's a system we are working on with some of my friends, automating it. Automating means you just tell it, this is where you buy, this is where you sell, this is where you close. So once the systems are trading automatically, traders have the added advantage of further backtesting the automated system. So you can backtest it. However, the very nature of robotic application is a double-edged sword. Since it's not discretionary trading takes place, an automated system can lull mechanical traders into a false sense of security. This false security becomes a problem when market conditions change. So you have to really test this system, especially with very volatile markets, like the last couple of few months, the markets were very, 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 very volatile. So when the system really works, even I think last week, NFP was huge. So no monitoring needed, flexible trading, free time, and so forth and so forth. So let me finish at that. So you will do the quiz, page 147, you check on the WhatsApp, so that at least we go to the order of the day. So at a social event, do you find your best friend as soon as possible? Do you move around and interact with as many as possible? Look out for interesting and popular people groups, sit in one corner and wait for people to talk to you, find a group of friends and join in the conversation. So once you answer those questions, answer them correctly, because once you answer them correctly, we'll now be able to profile what kind of a trader you are. Then from there now, we are going to work on your perfect strategy, depending with how you are going to answer this question. So I think that's it for a little bit of the psychology of markets and what type of trader you are. We are basically trying to think. If you really are an M15 person, M15 means you're more of a day trader, or more of a, you're looking at the time frame of 15 minutes and 30 minutes. We're going to get the perfect strategy for you. What time do you get in? What time do you get out of the markets? So that's what we're going to do. So for today, I wanted us to introduce you to candlesticks. So I have a book here. I'm going to send you this book. It's really nice. Everything you wanted to know about candlestick charts. So I'm not going to go through everything, but I'm just going to introduce you to what is a candlestick. So let me go back to Euro. So this is our euros. Can you see? Yeah, so the market was falling and now it seems to be rising. Why? 93%. We are going to see what kind of news is impacting this euro to start gaining. And you can see now on D1, we are about to start going up. So now I'm talking about these candlesticks. What are they? All these candlesticks is what I'm introducing. So that we are able to understand the psychology of what a candlestick is all about. Because once you understand what is a candlestick, you can be able to read the charts accurately. You can also be able to spot patterns quickly and easily. And also you can use that information to make profitable trading decisions. So candlestick trading is very, very important. No matter where you'll ever go, you'll always find candlesticks. When we go to the spot market, that's the Forex market. When you go to the stock market, when you go to crypto, even Bitcoin, let me show you. Because it's good, I'm always showing you different kinds of markets. Here is Bitcoin. So Bitcoin, You can see these are candlesticks. So I think it's at 57. Wow, it went up because yesterday I left it at 54,000. It was around here. Yeah, 54,060. So right now you can see we're at 57,000. So I'm expecting we go back to 60,000. Then probably once we break 64,000 on this resistance, now we'll be headed back to up to 100,000. So you know why? Because of inflation. Inflation is making the dollar very weak. And you can see this is why this trend is falling. Why is it falling? And then gold should be rising. Why is gold rising? Because of inflation and also because of oil. Oil has been on a rise. They are even having talks right now to see if they can be able to bring these prices down. So anyway, let's continue. So let's do our candlestick. Then we'll be relating with the market. So what is a chart? Anatomy of a candlestick, a doji, a marubozu. They have, you can see they have names. And then you're also able to understand the patterns. Harami, hanging man, shooting star, and then we have a cheat sheet. So it's not a very, it's just a 22-page book, but it has mostly what we are looking for in the candlestick. So before I start to talk about candlesticks, let's go right back to the basics of candlestick. So when you look at a chart of market prices, you usually choose from line chart to candlesticks. So let me go back to oil. So I'll be using oil because oil, at least it has a good definitive chart. You can see, whenever I zoom out a little bit, so that's my oil. You can see it's I just want a plain chart like this one so that I can be able to explain to you how this candlestick works. And then we can be able to see, then I'm also seeing some gap here, and then we can be able to understand what really this is all about. So you can draw a line chart. Let me draw a line chart. So a line chart looks like that. You can see it looks like a line. There's a W here. There was an M here. The market went down. There was another W, went up. There was also some consolidation here. Then the market has been on a rise. So right now, the market basically has been on a very, very, very strong rise. You can see we are at 83. So when I click on this line chart, it's not the same as when I'm using candlesticks. You can see when I use candlesticks, I can see candles. When I click here, I'll see a line chart. So a line chart basically is able to show me what really is happening. So a line chart will take its price levels from the opening or closing prices according to the time frame you have selected. So if you're looking at a 1 minute line chart of closing prices, it will plot the closing price for the last 1 minute. So let me go back. So this is weekly. If I go back to 1 minute, this is my line chart for 1 minute. So every minute, so that's how the market looks like on a 1 minute time frame with oil. So let me click. So it looks like that. So let's continue. So line charts can be useful for looking at the bigger picture and finding long-term trends. So even if you're scalping or day trading, the idea is which direction are you moving? Are you moving in the direction of the trend, or what are you moving? Because the idea is you just need to understand the price. Where is the price going? Is it going up or down? If you're going to trade 1 minute time frame like this one, look at the line chart. It tells you whether we are going down or we are going to be going up. If I use 5 minute time frame, the same. If I use 30-minute time frame, the same. If I use 4 hours and D1 and the rest, it can show me. So for me, let me be using weekly because we'll be forecasting the price. You can see we really need to know between now and December, where will our oil be going? You can see. So me, I'm waiting for it up to 100, at least 100. Let me draw my resistance here. Around 100. Oh, it can't move anymore. So just a minute. So 103. So let's wait for oil there. So that's our chart on oil. Let me zoom in a little bit. There we go. No. Zoom out. Then move like this. So let's have a look at it from that angle. Yeah, so that we can be able to see the candlesticks. So this is what I'll be explaining. So this candlesticks is what I'll be looking at. So let's go to the anatomy of a candlestick for a start. So understanding the clues candles hold. So candlesticks are now such a familiar part of our trading scenario. It's hard to believe that only 20 years ago, they were a strange and mysterious import from Japan. So let's go to, So this is the candlestick. Before we go to the candlestick, let's go to the guy who introduced the candlesticks. So, sorry. So a minute. So he's called Munehisha Homer. So this guy, so he's regarded as the father of candlesticks. So let's have a look. So I just want you to see it was this date of the death was 1803. So this is the guy who discovered candlesticks. So you can go read about him. He was a rice merchant, and there was one thing he was able to understand with the candlesticks. Let's have a look. Let's just have a look, because candlesticks, I'm just going to show you the anatomy, and then I'm going to go to the cheat sheet so that we can be able to understand when you see this candle, what happens. So this guy, he was the guy who discovered the candlestick, was a rice merchant from Sakata, Japan, who traded in the Dojima rice market in Osaka during this. He is sometimes considered to be the father of the candlestick chart, a form of technical analysis used in the stock market. So once you understand candles, you can also be using them in the stock markets. So around 1710, futures market emerged for rice. So they were trading rice, which had previously been traded exclusively on the spot. It used coupons promising delivery of rice at a future time. From this, a secondary market of coupon trading emerged, in which he flourished. This guy made over $10 billion just trading candlesticks. Stories claim that he established a personal network of men, and this was almost 300 or so years ago, a distance of 600 kilometers to communicate price. So how was he doing this? In 1755, he wrote The Fountain of Gold, or the Three Monkey Record. So what did it say? It made the first book on market psychology. So you can see, even when we are using, let's see, when was this? 1755 minus 20, yeah, it was around 300 years ago. So this is behavioral economic studies that affect the psychological, cognitive, emotional, cultural, and social factors of the decisions of individuals and institutions, and how those decisions vary from those implemented by classical economic theory. So market psychology basically is, why are we going up? Why is there hard psychology? Why is the market dropping or rising? So in this, he claims the psychological aspect of the market is critical to trading success. So this is very, very, very important. And that traders' emotions, your emotions, they have to always be involved. You can't run away from this. Like it or not, if you're going live, you're trading live, emotions have to come to play. They have a significant influence on the rise prices. And he notes that recognizing this can enable one to take a position against the market. When all are bearish, there's a cause for prices to rise, and vice versa. So how did he describe? He described the rotation of a yang, that's called a bull market, and a yin, a bear market, and claims that with each type of market, there's an instance of order type. And he appears to have used the weather and market volume as well as price. So anyway, so this is the guy. I wanted you just to have a look at a little bit of where the candlesticks came from. So let's go back. So this is the anatomy of a candlestick. So this is our opening price. So if we are buying, this becomes our opening price. Then this becomes our low. Then this becomes our high, and this becomes our close. If we are selling, this becomes our open price. And then it creates a low. No, yeah, this is a low. And then when we go down now, it creates a high. And then it creates a low. I mean, a close. Close means that's where the candlestick is able to close. So we have a doji. So this is one of the most important candlesticks I want you to understand. It looks like this, where the opening and closing prices are the same. So here nobody is winning. So when you see a doji, most likely there is not much volatility, or there might be a reversal. So you can see they look like a plus, and then they're usually very short. The others look like dragonfly doji, gravestone doji. So what's the key to a doji? That neither the bears nor the bulls have gained control, and that the price has ended where it began. It's a sign of indecision in the market, and could, in conjunction with other indicators, signal a change in market direction. So when you see this doji, most likely we might be seeing a change. So you can see there were dojis here. Applying doji candlesticks, a good trick to look out for the doji near the edge of the. So mostly this is a trend line. We did trend lines last time. You can see there was a doji, market went down. Came up again, there was another doji, market went down. So we are looking at a doji as a reversal. So we have also a marubozu. Marubozu is a long candle, which implies that the day's trading range has been large, and it should have no upper or lower wick. So it doesn't have wicks. It looks like this. So what does it signify? a green or white Marubozu signals strong conviction among buyers, while a red or black Marubozu indicates sellers are eager to flee. So you can see, if you see this long Marubozu, that price should be really going up. Like I can see there was a Marubozu here, and there was also another one. Can you see this one? This one was a very strong Marubozu. So that's why it caused the price of oil to really go up. Let me look for another Marubozu. So mostly it doesn't have a wick. So I'm only seeing one here. When we were selling, yeah, there was also another one while the price was falling. So this was a strong Marubozu. So you can see the price had to dip down. So let's continue. So that's the Marubozu. So then we have Harami. Looks like this. It is indicated by a small body of opposite color completely contained in the body of the previous session. So it's usually within, inside. So as you can see, the body of the small black candle is completely within the confines of the body of the previous candle. You can see it's somewhere inside. This indicates that the upward trend is running out of steam. So that is to mean this might be a very strong reversal going back. So you can see this is a Harami, bullish Harami. There was a strong sell. When you see a Harami, there's a reversal about to happen. And then which one else? Let's go see another one. We also have a hammer. Hammer looks like just a normal hammer. It's a candlestick pattern that consists of just one candle. Although the candlestick, it is always best to view them in context of candlesticks around them. So a hammer is found in a downward trend and signals a bullish reversal. The long lower wick shows a period in which sellers were in control, but the body shows the buyers coming back in. So you can see, you'll see it, especially after a strong sell, you'll always find a hammer will cause a big reversal. So then we have a hanging man. So an inverted hammer. So what I'm going to do now, let me go to the cheat sheet because of time, so that we are able to see all of them down here. I'm going to send you the book. Don't worry, immediately right now after class, I'm going to drop it on the WhatsApp group so that at least you can go through it. So go to the last page. So here they are. Doji. So these ones are more of bullish and these ones are bearish. Means these ones are looking to push the price up and bearish patterns are looking to push the price down. So you can see Marubozu I have touched, Harami I've also touched, Hammer I have touched, inverted hammer. The small body at the bottom of the trading range should concern bears could form a morning star. So if it's an inverted hammer, we are looking to start going up. Engulfing, you'll see it very many times. It engulfs within. The first candle reflects strength. Second candle's body engulfs the size of the first candle. Let me show you an engulfing. So this one was an engulfing here. Engulfing is very common. Yeah, like around this area. Can you see this one? This one was an engulfing because you can see the close price of the sell was the open price of the buy. And then it was followed by a very strong buy. So that was that is what we call an engulfing. Then we have a morning star. First candle is long and black. Second gaps below. First close and trades in a small range. Third and long white. So I'm seeing like we have sorry, it's my Skype. So then we have three white soldiers and piercing line. So basically these are the candlesticks. So these ones you have to master them. They have to be at the palm of your hands because every now and then you'll be seeing them. So I'm going to send you this because this will be assignment for today and for the week, because now we'll be getting in touch with candlesticks and we will be using them on a daily basis. So I think I didn't have much. So for today, that was much I would have done for candlesticks and a little bit of understanding your psychology with the market and your personality. So unless you have any questions, I think I'll call it a day. We only have less than a minute and then we're out. Any questions? We'll send the book. So I'll send the book to you. So let's end it at that and call it a day. Then we'll link up on Tuesday next week. So thanks guys for your time, and I want to wish you a happy trading week and a wonderful afternoon. So thanks all for your time and have a lovely day. So for now, let's call it a day. So thanks for your time. So I'll be linking up with you on psychology, not just on psychology, also understanding your trading psychology. So once we do that, now you'll be able to start trading live. So thanks for that. I'll follow you up on the WhatsApp group once I send the book. So unless we have any questions, let's end our class at that. So thanks, guys and ladies.